For much of 2026, Abbott was becoming a difficult stock for investors to defend. The company remained a high-quality healthcare franchise, but the market was increasingly focused on slowing momentum, pressure in nutrition, and the possibility that Abbott's best growth years were behind it. Then came the second quarter. Abbott delivered $12.6 billion in revenue, beat earnings expectations, and raised full-year adjusted EPS guidance. Medical devices remained strong. Cancer diagnostics added a new growth dimension following the Exact Sciences acquisition. And management pointed to accelerating sales and earnings growth in the second half of the year. But this was not simply a good quarter. It challenged the market's previous framework for valuing Abbott. The question is no longer whether Abbott can still grow. The question is whether the market underestimated what the next phase of growth could look like. The market's concern was never that Abbott had suddenly become a bad business. That was not the issue. The concern was whether a company of Abbott's scale could continue to deliver the growth required to justify a premium valuation. The stock had come under pressure as investors focused on weaker areas of the portfolio and the possibility that Abbott's growth trajectory was moderating. This created a gap between the quality of the company and the market's perception of its future. Abbott was still generating billions in revenue across healthcare, but investors were becoming less willing to pay for growth they believed was becoming harder to find. That was the setup going into Q2. Expectations had become more cautious, and the next earnings report suddenly mattered a lot more. Abbott reported second quarter sales of $12.59 billion and adjusted EPS of $1.31, both ahead of expectations. But the more important signal came from the guidance. Abbott raised full-year adjusted EPS guidance to $5.45 to $5.60 per share. That may look like a modest adjustment. Strategically, however, it matters. Abbott was not simply benefiting from a strong quarter and maintaining its outlook. The company was telling investors that the earnings trajectory had improved. Management also pointed to momentum building across the portfolio and accelerating sales growth in the second half. This is the kind of development that can force a market to reconsider its assumptions. The story was no longer simply about defending growth. It was about whether growth could begin to accelerate again. The most important strategic change may be diagnostics. Reported diagnostics sales increased 42% to $3.09 billion, largely reflecting the addition of Exact Sciences to Abbott's portfolio. But the significance goes beyond the headline growth rate. Abbott has now added a major cancer screening platform to an already diversified healthcare business. Cancer diagnostics grew 13.3% on a comparable basis in Q2, supported by Cologuard and both new and repeat users. That gives Abbott exposure to a powerful healthcare trend, detecting disease earlier, before treatment becomes more complex and expensive. The strategic question is whether Abbott can use its global scale to expand the reach of these platforms. If it can, Exact Sciences may not simply add revenue to Abbott. It may change the long-term composition of Abbott's growth. But Abbott's investment case does not depend on diagnostics alone. The core engine remains medical devices. The segment generated $5.85 billion in second quarter sales and grew 8.4% on a comparable basis. Electrophysiology was particularly strong, growing 13.4% on a comparable basis, supported by the rollout of new technologies including the Volt pulsed field ablation system. This is important because it demonstrates the depth of Abbott's innovation engine. The company is not relying on a single blockbuster product to drive growth. It has multiple cardiovascular platforms, each targeting large and evolving markets. For Abbott, this is the foundation beneath the new growth story, Diagnostics adds a new dimension, while medical devices continues to deliver the core growth. The next question is FreeStyle Libre. Abbott has built one of the world's most important continuous glucose monitoring franchises. But the long-term opportunity is larger than the sensor itself. The strategic ambition is to make glucose data more continuous, more accessible, and increasingly integrated into the broader management of metabolic disease. The opportunity is also becoming more competitive. Abbott therefore has two jobs: defend its existing franchise and expand the market around it. If Libre remains primarily a successful product, it can continue to generate substantial growth. But if Abbott can turn the platform into a broader digital and metabolic health ecosystem, the economic opportunity becomes much larger. That is why Libre remains one of the most important long-term tests of Abbott's ability to compound beyond its current scale. The bullish case still has an obvious weakness: nutrition. The segment declined 3.1% on a reported basis in Q2, and comparable sales were down 3.6%. Management has pointed to sequential improvement, new products, and pricing actions, but the recovery is not yet complete. This is important because it keeps the Abbott thesis grounded in reality. The company has not suddenly turned every part of its portfolio into a growth business. Instead, the investment case depends on mix. Diagnostics is becoming strategically more important. Medical devices remain strong. Established pharmaceuticals continues to grow. Nutrition is the segment that needs to stabilize. The question is whether the growth engines can expand fast enough to offset this weakness. If they can, nutrition becomes a manageable problem. If they cannot, the portfolio's overall growth rate remains vulnerable. This is where the story becomes more interesting. Abbott does not need one miracle product to restart growth. It needs several businesses to perform well at the same time. Medical devices is already delivering strong growth. Cancer diagnostics adds a new platform with long-term potential. FreeStyle Libre remains a major franchise. Established pharmaceuticals continues to expand across emerging markets. And nutrition may be moving toward stabilization. The investment thesis is therefore becoming less dependent on a single catalyst. The real opportunity is portfolio-level acceleration. If multiple businesses improve simultaneously, Abbott can generate stronger and more durable earnings growth than the market expected. Abbott may not be reinventing itself. It may simply be entering a period where more of its existing assets are finally contributing to growth at the same time. The new narrative does not eliminate the risks. Exact sciences must be integrated successfully, and the growth opportunity in cancer diagnostics must translate into sustainable economics. Nutrition still needs to recover. Competition remains intense in diabetes care and medical devices. And the stock has already responded sharply to the earnings report. That last point is critical. The better the fundamental story becomes, the more important valuation becomes. Investors now have to separate two questions. Is Abbott a better business than the market believed before Q2? The evidence suggests the answer may be yes. Is the stock automatically attractive after the market reprices that improvement? That answer is much less obvious. The fundamental story may have improved. The margin of safety may not have improved by the same amount. Abbott's updated 2026 adjusted EPS guidance is $5.45 to $5.60 per share. That gives us a clear starting point for valuation. The important change is not simply the earnings number. It is the market's perception of the earnings trajectory. Before Q2, investors were increasingly concerned that growth was slowing. After Q2, the market is now considering the possibility of accelerating growth in the second half and beyond. That can support a premium multiple. But the valuation question remains. If diagnostics continues to scale, medical devices sustain strong growth, and nutrition stabilizes, the current valuation may be justified by a stronger earnings trajectory. If those improvements fail to persist, the stock may have less room for disappointment. A high-quality business can be improving fundamentally while the investment becomes less attractive at a higher price. This chart shows Abbott's valuation through 3 different reference points. The conservative value is $62, while the optimistic value is $147. These are not price targets, and they are not recommendations to buy or sell the stock. They represent valuation levels that Abbott has previously reached during different phases of its market history. The $125 figure is different. This is Abbott's current fair value based on the company's latest full-year operating performance and the underlying earnings power of the business. So the purpose of this framework is not to predict where the stock will go next. It is to separate 2 things investors often confuse: the price the market has previously been willing to assign to Abbott, and the value that the business fundamentals currently support. The market can move across a wide range. Fundamental value evolves more gradually. That distinction is the key to understanding Abbott's valuation. The most important conclusion is not that Abbott had a strong quarter. It is that the market may have been evaluating the company through an outdated framework. The old story was a mature healthcare giant trying to defend its growth rate while parts of the portfolio weakened. The emerging story is different. Medical devices remains a powerful core engine. Cancer diagnostics adds a new strategic growth platform. FreeStyle Libre continues to offer long-term optionality. Established pharmaceuticals is growing. And nutrition may be moving toward recovery. The risks are real, and valuation now matters more than it did before the earnings report. But the central debate has changed. Abbott is no longer simply trying to prove that it can remain a high-quality healthcare company. It now has to prove that its next phase of growth can be stronger than the market previously believed. And that is why Abbott just changed the story. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.